Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss recent concerns about the financial system due to credit markets and private lending and what they mean for long-term investors. Over the past month, you may have seen headlines about bankruptcies and fraud cases involving private companies that borrowed from regional banks and private lenders. These stories can be unsettling, especially when they spark comparisons to past financial crises. JP Morgan CEO Jamie Dimon recently said that when you see one cockroach, there are probably more. However, understanding the context is crucial when it comes to our portfolios. There's an important difference between one-off cases that impact banks and problems affecting the entire financial system. Over the next few minutes, we'll provide perspective that can help us think about the situation. Let's start with how lending has changed since 2008. Due to regulations that were put in place after the global financial crisis, significant lending activity has shifted away from traditional banks to non-bank lenders. These include private credit funds, mortgage companies, and online lenders. The key difference is that these institutions don't accept customer deposits, so they're not subject to traditional banking regulations. This sector is sometimes referred to as shadow banking because it adds complexity and less transparency to the financial system. Now, banks are still involved because they've extended about $1.2 trillion in loans to these non-bank lenders, creating an interconnected web of credit relationships. The recent few bankruptcies have raised concerns that maybe there are cracks in the system. This led to some market volatility for a few weeks. However, markets have stabilized since then. This chart shows the history of credit yields and how stable they have been more recently. In general, banks are still very well capitalized and have been focused on these challenges. Let's compare today's situation to past crises. The 2008 financial crisis wasn't just about fraud or the housing crash. What made it systemic was the significant financial leverage at the largest institutions. In many cases, these leveraged positions eclipsed the total amount of equity held at each company. A more relevant comparison might be the 2023 banking crisis, when several regional banks failed within days of each other. That crisis revealed problems from the mismatch between bank assets and liabilities when interest rates rose rapidly. While those concerns were at the time, it didn't translate into a broader economic downturn. The 2023 crisis demonstrates how quickly confidence can evaporate in modern financial markets and how quickly it can rebound. So, what have the markets been telling us? The stock market has experienced short periods of volatility in recent months, driven by various factors, including tariffs, government shutdown concerns, and questions around AI companies. Yet, during this period, major stock market indices have also continued to reach new all-time highs. This chart shows that bond market volatility has actually been falling recently as well. For long-term investors, the key lesson is that headlines around financial fraud and bankruptcies are part of the credit cycle. While individual cases may be concerning, this is separate from whether it affects the broader financial system. We hope you found these insights helpful. If you would like to discuss any of these topics more, please don't hesitate to reach out. We look forward to speaking with you.